financial accounting information and looking at the framework or conceptual framework of regulatory bodies, then we move now to accounting structure theory. The theory attempts to explain current accounting practice and predict how accountants will react to certain situations or how they will report specific events. This theory will help the accountants in taking action, in providing information which will be consumed. The theory relates to the structure of the data collected, process, accounting, and financial reporting. So the theory gives us a process which is followed in data collection and financial reporting, directly connected with accounting practice. So all the accounting practice, from the original entry to journalization to posting to preparation of financial statement to analysis and interpretation, also called classical theory, descriptive theory, or traditional theory. So when you talk about accounting structure theory, think about classical theory or descriptive theory or traditional theory. In other words, it follows the inductive approach. Contributors. Who are these contributors? William A. Burton, Accounting Theory with Special Reference to Corporate Enterprises, 1922. We have Henry Renan Hadfield, Accounting, Its Principle and Problem. Henry Webb Sweeney, Stabilized Accounting, that's 1936. Robert Stalin, John O. Telsform, and Richard E. Flaherty, Exchange Valuation, and Empirical Test Accounting Review Act. So these are actually the contributors towards the accounting structure theory. Remember, accounting structure theory brings us, showing us the structure of data collection and financial reporting. Stalin advised to observe accountants' action and rationalize this action by submitting them under generalized principle. So that was actually the assumption of Stalin. Such theories relating to the structure of accounting can be tested for internal logical consistency, or they can be tested to see whether or not they actually can predict what accountants do. So it's all about preparation and prediction. Number 2 is the limitation. 1. It concentrates on accounting practice and the behavior of practicing accountants. The accounting practice begins with observation, occurrence, transaction, translate them into symbolic form, money values, and make them inputs, sell and cost, into the formal accounting system, where they are manipulated into output financial statements. Inconsistencies in traditional theory have given rise to alternative accepted principles and procedures which give significant divergent report results. So again, there is inconsistency in traditional theories or in structural theories. Prohibit the advancement of knowledge. So it actually limits the advancement of knowledge, furthering the study. Interpretational theory. So this is based on how we can interpret the information. So the theory attempts to give some meaning to accounting practice. It emphasizes on giving interpretation and meaning as accounting practice are followed. So it emphasizes on giving interpretation and meaning as accounting practice are followed. The theory provides suitable basis for evaluating accounting practice, resolving accounting issues, and making accounting proportions. The theories are part of the classical accounting theory. So this theory is still part of the classical theory. All is all about how do you interpret information as far as accounting information is concerned. The contributors, we have John B. Canning, The Economics of Accountancy, Sidney S. Alexander, Income Measurement in Dynamic Economy, 1950, Agar O. Edward and Philip W. Bell, The Theory and Measurement of Business Income, Robert Sproul and Maurice Monins, The Tendency Set of Board of Accounting Principles for Business Enterprise. So at your own time, you can go through these contributors and learn more. What are they saying about interpretation? The authors of this theory are more analysts and explicators than advocates and preachers. So the authors of this theory are more analysts and explicators than advocates and preachers. They analyze and assess the accountants do and seek do. What accountants do and seek to do. They undertake to explain a phenomenon to accountants and help in understanding the implication of using accounting concepts in the real business situation. Give meaningful interpretation to these concepts and rules and evaluate alternative accounting procedures in terms of this interpretation and meanings. For example, it can be said that first in, first out, which is called FIFO, is the most appropriate if objective is to be measured current value of inventories. This theory attempts to find ways to improve the meaning and interpretation of accounting information in terms of experience about human behavior and information process capacity. So in other words, you look at FIFO, meaning first in, first out. So your recording is based on current value, not historical value. To build a correspondence between the interpretation of producers and users as to accounting information. The theory emphasizes on the relevance of the information communicated to the decision making and on individual and group behavior caused by the communication of information. Accounting is assumed to be action-oriented. Its purpose is to influence action, that is, behavior, directly through the information content of the message conveyed and indirectly through the behavior of preparers of accounting reports. So in other words, we are saying accounting assumes the action-oriented, whereby the user and the preparer have the same behaviors. They have particular behaviors. The one who is using and the one who is preparing must have a particular type of behavior. They must reflect particular type of behavior. The focus is on the relevance of the information being communicated to the users. Why? Is because when the users consume this information, they are supposed to make useful decisions, conducive decisions, rational decisions, attempt to measure and evaluate the economics, psychology, and sociological effects of alternative accounting procedures and modes of financial reporting, also called behavioral accounting. So it's also called behavioral accounting. So when you talk about decision usefulness theory, we look at the behaviors of both the users and the makers of information. Two major aspects of decision usefulness theory. Who are users of financial statements? So we are asking one question: who are the users? Number two, we are asking what the decision model or problem of financial statement users. What are the decision models? So there are only two aspects that we are looking at: who are the users and what are the decision models. decision models, and decision users. That is all about decision usefulness theory. We'll further engage in the decision usefulness theory